The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate.
This deterioration and to what extent it could be a leading indicator for hard data.
We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. Forecasting is always very, very hard, and in the current situation, I just think its uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, as I mentioned, I think we're well positioned to wait for further clarity and not in any hurry.
Are you effectively reading this as a one-time price level shock?
You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
Environment in which inflation is so low and stable over time that it doesn't materially enter.
We think that the right thing to do is to wait here for greater clarity about what the economy is doing.
The new administration's policies in the economic numbers yet, and when do you anticipate that happening?
If it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers just they just kind of followed the crowd and raised it. So things happen very indirectly, and so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
You seem to not be placing the same weight on that, and so I'm just wondering.
We look at it. We don't dismiss data that we don't like. We force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer-run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Still solid. What is your message to consumers that clearly disagree?
We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more at the price level.
The uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that
we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal.
And underlying private job growth, and do you see the composition of job growth as something that has policy?
We may or may not stop MBS runoff, though, because we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Or consumer spending, especially among higher income households?
We have seen inflation move down from, higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the twos, with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that. Thanks very much.